Let's be real, the stock market can feel, well, pretty complicated, right? You hear all this jargon, you see these crazy charts zipping around on the news, and it's easy to just tune it out. But what if I told you that that entire massive universe is really built on just one single, incredibly simple idea? An idea that, honestly, anyone can get. And that idea is a share. That's it. A share is simply a small piece of ownership in a company. So when you buy a share, you literally become a part owner of that business. It really is that straightforward. No fancy terms needed, it's just ownership. You know what? To make this crystal clear, let's use an analogy. Go ahead and picture any big company that you know. Now imagine that whole company, I'm talking all its buildings, its products, its brand, everything, is one giant pizza. Okay, you got it? Each individual slice of that pizza is one share. If you buy a slice, you own a part of the whole pizza. You buy more slices, you own a bigger piece of the company. It's really that easy. Okay, so that makes sense for us as buyers. But why would companies want to sell off these slices of themselves in the first place? Well, it all boils down to raising money to get bigger and better. And that's a really good question. I mean, if you've got a successful business, why would you sell off pieces of it? Why not just, get a loan from a bank or something? Well, selling shares is an incredibly powerful way for companies to get their hands on money or capital for their biggest projects. They use that cash from investors like you to grow the business, maybe expand to new countries, or fund the research for that next game-changing product. So the company gets the cash it needs to grow. Great for them. But what's in it for you? How does owning that tiny slice of the pizza actually put money in your pocket? Well, there are two main ways. First, you've got capital gains. This is the classic buy low, sell high. If a company does well, more people want its shares, the price goes up, and you can sell your share for a profit. The second way is with dividends. Think of these as a little thank you bonus from the company. They've made some profits, and they decide to share a portion of it directly with you, the owners. And by the way, whenever you hear people talking about buying stock, they're almost always talking about common stock. That's the standard type that gives you that piece of ownership, the potential for those dividends, and often even the right to vote on big company decisions. Okay, making money is awesome, but, and this is absolutely crucial, investing is not a sure thing. It's not a one-way street, so we have to talk about the risks involved. So let's just ask the question straight up. Do share prices only go up? And a direct, simple answer is a big, fat no. They don't. A share's price can definitely go down, and it's all about supply and demand. If a lot of people are selling and not many are buying, the price will fall. And this can happen for all sorts of reasons. Like the company isn't performing well, some bad news comes out, or even if the entire stock market is just having a bad day. This leads us to the biggest risk of all, and the question that might be nagging you right now. Is it possible to lose all of your money? And the honest answer is yes. Now, it's not common, but in a worst-case scenario where a company goes bankrupt, the value of your shares, your ownership, can drop all the way to zero. And this is exactly why you hear people talk about diversification, the idea of not putting all your eggs in one basket. Now, that might sound a little intense, but please don't let it scare you off. Knowing the risks is what empowers you to invest smartly. So let's pivot and talk about what your first steps could look like. Here's a super simple three-step approach. First, start with what you know. Invest in companies whose products you actually use and whose business model you understand. Second, start small. You don't need a fortune to get in the game. And third, focus on the long term. Real wealth building usually isn't a get-rich-quick scheme. It's a marathon, not a sprint. All right, we've covered a ton of ground here. So before we wrap this up, let's do a quick-fire recap of the 5 most important things to remember. Remember, a share is just a piece of ownership. Companies sell shares to get cash to grow. You can make money from the price going up, capital gains, and from the company sharing its profits, dividends. But prices can go down too, so there's always risk. And finally, for beginners, starting small and thinking long-term is always a smart move. As you start to explore this world, just keep this in mind. Every single expert investor out there was once a total beginner. Every one of them started exactly where you are right now, learning the basics. So, I'll leave you with this final thought. Now that you know a share isn't some crazy, complex financial thing, but just a simple piece of ownership, what's the first company you'd want to own a little slice of? Thanks for tuning in.